Welcome back to the deep dive. Today, we are tackling something that's, well, it's a huge paradox for almost everyone, your car.
It really is. You need it for, everything, but it's also this massive depreciating asset.
A relentless one. I mean, you've got the initial costs, the insurance, fuel, maintenance. It just never stops.
The costs are staggering.
Yeah.
And they start the second you drive it off the lot.
Exactly. It's one of the most expensive things we own. So our mission today is to cut through all that. We've dug through the labyrinth of IRS rules to find 6 real proven strategies to help you offset some of those costs. We're talking legit tax deductions and credits.
And we've distilled this for everyone. For the commuter, the freelancer using their car as an office, the small business owner, even some W-2 employees. This deep dive is really about application, using the tax code to keep your own money.
Okay, so we've got personal strategies, some green-focused ones, and some pretty aggressive business strategies. But before we get into any of that, there's one foundational rule. It applies to everything.
And if you ignore this, everything else we discuss is, well, it's pretty much meaningless.
So what is it?
Record keeping. I know it sounds boring, but it's the absolute bedrock of all of this.
For everything.
For everything. Whether you're claiming, a $50 repair or a massive $27,000 depreciation deduction, without bulletproof documentation, you have nothing.
So mileage trapping apps, a folder for receipts. Get that sorted out first.
That's your prerequisite, yep.
Okay, let's start with strategies for the average person. We'll look at cars at the end of their life and then brand new ones.
Right. And strategy 1 is something people often overlook when they're just trying to get rid of an old car. Donating it.
Oh, I've been there. Trying to sell an old car privately is a nightmare.
It's an absolute headache, right? All the emails, the no-shows, the haggling over every little scratch.
Just to get maybe a few $100.
Exactly. So instead of all that hassle, you can donate it to a registered charity. It saves you all that time and you get a deduction. And it doesn't matter if it was a personal car or a business car.
And a lot of them will come pick it up, right?
Anyway, yeah, they handle all the logistics.
But wait, how do I know that deduction is better than, say, $500 cash from a private sale?
Well, that depends on your tax bracket, honestly. But
Yeah.
the big benefit is often just the convenience and getting a fair market value that might be higher than what you'd get in a quick sale. The key, though, is the paperwork.
Of course.
You have to get an official receipt from the charity. It needs to detail the car's value and what they did with it.
Okay, so that's the safe path for the old clunker. Let's jump to the other end of the spectrum. Strategy 2, the Federal Electric Vehicle Tax Credit.
This is the big one everyone talks about, a potential credit of up to $7,500.
Which is a huge number.
It is, but the details are incredibly specific. And this is where people get tripped up. The first big detail is that this credit is non-refundable.
Non-refundable. Okay, that sounds like a tax term. What does it actually mean for me standing in the showroom?
It means the credit can only reduce your tax bill to 0. It cannot generate a refund check that comes back to you.
Ah.
So let's say you qualify for the full $7,500, but after all your other deductions, you only owe the IRS, say, $3,000 in federal tax.
Then I only get $3,000 of the credit.
Exactly. And the other $4,500, it just vanishes. You can't carry it forward to the next year. It's gone.
Wow. That is a massive nuance. You have to have a high enough tax liability to begin with.
Absolutely critical. And then there are the income limits, the AGI caps.
Right. They don't want millionaires getting this.
Precisely. It's under $150,000 for individuals, $225,000 for heads of households, and $300,000 for married couples filing jointly.
And the rules for the car itself seem to change, like every other week.
They do. It's complex, beyond the basics. It needs an external plug, weighs less than 14,000 pounds. You've got these 2 big phase-outs to worry about. First is the manufacturer phase-out. Once a car maker has sold 200,000 qualifying EVs, the credit for their cars just disappears.
Yeah.
Some of the early players have already hit this.
No way. So if you're looking at a brand that got into the EV game early, you might be too late for the credit, even if you're buying a brand new car.
You might be. And then it gets even crazier with the supply chain rules.
Supply chain.
Yep. For vehicles you took possession of after April 18th, 2023, the car has to meet these super specific rules about where its battery minerals and components come from.
You're kidding me. So I'm supposed to know the mineral sourcing for my car battery. How does anyone navigate that?
The short answer is you have to rely on the dealership and the IRS website. They keep a list of qualifying vehicles, but even that list can change. The takeaway is check the VIN and the rules right before you buy.
Sound advice. Okay, strategy 3 is a bit of a pivot. Let's say I have a newer car I like, but I want the green benefits.
You can convert it to electric drive. This is alternative path, yeah. You have a professional mechanic install a conversion kit.
And for a newer car with a lot of life left, that could make sense.
It could. The upfront cost can be pretty high, but you offset it with fuel savings over, the next 10 years.
But this isn't a weekend DIY job, I'm guessing. There have to be regulations.
Oh, it's highly regulated. The equipment has to be certified by the EPA. The mechanic has to be a qualified system retrofitter, a QSR, and it all has to meet highway safety standards.
For safety, that makes total sense. So what's the big caveat?
The cost. You really need to get a mechanic's opinion first. If the conversion costs 15 grand and your car only have a few years left in it, the math just isn't going to work.
Okay, so personal tax breaks are pretty limited, but the game changes completely for anyone using their car to make money, right? The freelancers, the gig workers.
This is where it really opens up. You move from credits to actual write-offs.
Which brings us to section 2, business use deductions. Strategy 4 is for the self-employed.
Right. If you're a freelancer, a consultant, a sole proprietor, you can deduct expenses for business use, even on your personal car.
And the list of what you can deduct is pretty long.
It is. It's really broad. We're talking depreciation, gas, tires, repairs, maintenance, insurance, even your registration fees.
That sounds like almost everything.
Sure.
So how do you prove what percentage of that is for business?
And that is the key. It all comes back to our first rule, meticulous mileage records.
The logbook?
The logbook. You have to prove the percentage of your total miles that were for business. So if you drove, say, 15,000 miles in a year, and you can prove 9,000 of those were for client meetings or deliveries.
And 60% of all those costs, gas, insurance, everything, are deductible.
Exactly. The burden of proof is entirely on you to justify that 60%.
Makes sense. Okay, let's talk strategy 5. Maintenance for a small business or, a dedicated business fleet.
If a vehicle is used exclusively for business, 100%, then all its running costs can go into your operating expenses. But this is where the IRS makes a fascinating distinction.
What's that?
The difference between a simple repair and a major overhaul.
Why does that matter in the eyes of the taxman?
It's all about timing. A simple repair like replacing brake pads or getting new tires, that's just routine maintenance. Those costs are deductible immediately in the current tax year.
Okay, an immediate write-off for a fix. So what's an overhaul?
An overhaul is something major, like rebuilding the entire engine. That's not maintenance. That's an investment that significantly extends the life and value of the vehicle.
So it's not like repainting a wall, it's like adding a new wing to the building.
That's a perfect analogy.
Hmm.
And that cost does not qualify as an immediate deduction. It has to be capitalized and then depreciated over several years. It's a huge deal for cash flow.
And you mentioned something about loans for repairs.
Yeah, that's a great little nugget.
Yeah.
If you have to take out a loan for necessary auto repairs, the interest you pay on that loan may also be deductible.
Good to know. Now for strategy 6, which gets into some really aggressive write-offs tied to vehicle weight. Let's start with the standard depreciation.
So if you buy a vehicle for your business, you can deduct its depreciation. For a standard passenger car, that deduction is generally capped at $19,200 in the first year.
Okay, 19.2. And what about for a bigger vehicle, like an SUV?
The IRS gives a bigger allowance there. For an SUV used for business, the deduction can jump up to $27,000 in that first year.
$27,000, that's a big jump.
It is. The thinking is that it's a more work-focused vehicle. But here's where it gets really interesting. The heavy vehicle exception.
This sounds like a game changer. How does the weight factor in?
It's a huge deal for tax planning.
Yeah.
If you buy a vehicle that weighs more than 6,000 pounds, but less than 14,000.
That specific range.
Yes. It gets treated as other property used for transportation. This means it can qualify for Section 179 expensing rules.
Which means what in plain English?
It means you can often deduct the full purchase price of the vehicle in the first year up to the Section 179 limit. This can be way more than that $27,000 cap.
Well,
as long as it's used more than 50% for business. This is exactly why you see so many business owners driving very large SUVs and trucks.
so that 1,600-pound threshold is the magic number they're aiming for.
It's often the key reason for choosing a specific model, yes. It's a massive immediate tax offset.
And what about the interest on the car loan itself?
That can also be deductible, but only for qualified individuals.
And who qualifies?
Mostly people using it for work. The self-employed, armed forces reservists, qualified performing artists, certain government officials. The interest deduction is tied to the business use.
Which brings us perfectly to our last section, Section 3, the exception list. This is for the average W-2 employee.
Right.
If I drive my own car for work every day and my company doesn't reimburse me, can I deduct those costs?
For most people, absolutely not.
Really? Not at all.
No. Since the 2017 tax changes, unreimbursed employee expenses for vehicle use are, for the most part, gone. They were suspended.
That's a huge misconception then. I think a lot of people assume they can write that stuff off. So who are the few that still can? Who's on this qualified list?
It's an extremely narrow list. The government kept it for very specific, non-traditional jobs. You have to be an eligible educator or a qualified employee.
And what is a qualified employee in this context?
It's a short list. Armed Forces reservists for their travel to drills, qualified performing artists because they travel so much, fee bases, state or local government officials, and employees with impairment-related work expenses.
So if you're a standard marketing manager driving all over the state and your company is just cheap about reimbursement,
You are generally out of luck for that deduction.
that's rough. And I imagine for those few who do qualify, the record keeping is even more intense.
It's incredibly strict. You need a perfect log, every mile, the time, the place, the specific business purpose. It has to be pristine.
Okay, let's wrap this all up. So what does this all mean for the listener?
It really boils down to three main paths. First, the green incentives, the EV credits, but you have to watch those income limits and that non-refundable rule like a hawk. Second, donating an old car. It's a simple, clean deduction.
And the third?
And third, the business use. This is where the real savings are, but it requires that bulletproof mileage tracking and understanding that key difference between a repair and an overhaul.
And we've given you the hard numbers to look for. That $19,200 for cars, $27,000 for SUVs, and that huge incentive built around the 6,000-pound vehicle exception. These are real planning targets.
Exactly. Knowing the rules is one thing, but applying them is everything. The diligence is what separates someone who saves thousands from someone who's just guessing.
Which leads us to our final thought for you. A bit of a gut check question. If you had to face an IRS audit tomorrow with only the vehicle records you've kept for the last 60 days, your mileage logs, your receipts, would you be ready? Let that question be your motivation, your prompt to get your habits in order right now, because that's the foundation for everything. And look, given how complex this all is, especially with the EV rules changing, always talk to a qualified tax professional. They can help you make sure you're getting everything you're entitled to, safely and legally.
Excellent advice. Time to start logging those miles. We'll see you on the next deep dive.